Hi, everybody. I'm Michael Reinking, coming to you straight from the trading floor of the New York Stock Exchange. So as we were with you last time, we had mentioned that this week was going to be the last really busy week of 2023, and it has not disappointed. So over the last few weeks, equity markets have been consolidating in a pretty tight range ahead of the last major catalyst of the year. And on Friday, we got an employment report, which came in slightly better than expected, and kind of falling into that Goldilocks bucket of job creation. And equity markets started to test the upper end of that range. We had extended a little bit higher following this week's inflation data, which was largely in line with expectations, leading us into Wednesday's Fed rate decision. Now, there had been some concern building that Chair Powell would strike a hawkish tone, as we've seen financial conditions easing and treasury yields moving sharply lower over the last month. However, we got anything but that. So the statement suggested that we had seen the end of the tightening cycle. Within the summary of economic projections, officials projected 75 basis points of rate cuts next year, moving it a little bit closer to the already pretty aggressive kind of market expectations. And Chair Powell's press conference was surprisingly dovish, right? So he had acknowledged that the conversation around rate cuts had already begun, and suggested that the Fed was aware of keeping policy too restrictive for too long. A very big shift from the higher for longer mantra that we've heard over the last year. So this was a much more dovish pivot than anybody had really expected, and that led to kind of an everything rally where we'd seen equity markets, treasuries, other fixed income products, and commodities markets all moving sharply higher. So the S&P 500 was up about 1.5% yesterday, breaking above 4,700, within 2.5% of the all-time highs. The Dow Jones Industrial Average did hit a new all-time high, breaking above 37,000. But the big outperformer was the Russell 2000, which was up over 3%, and it's now up over 20% from the lows hit at the end of October. Treasury yields have moved sharply lower. Two-year yields were down over 30 basis points yesterday. The 10-year yield is broken below 4%, is now down over 100 basis points from the highs hit in late October. Right, so this was the last real impediment to a year-end rally. But at this point, the question really becomes, just have we come, kind of too fast, too far, as we've had, kind of trading conditions move from extremely oversold at the end of October, to a short-term overbought here, more recently. Now, from here, the macro calendar is going to get a little bit more quiet, but we do have a very big liquidity event on Friday, as it is triple witch expiration, the simultaneous expiration of stock options, index futures, and index options, as well as the S&P quarterly index rebalances. This does tend to be one of, if not the heaviest trading day of the year. Well, that's going to do it for this week. Thanks for joining me. I'm Michael Reinking. This has been your Weekly Brief.